Hi everyone, my name's Daryl Payne, CEO at As Good as Gold Australia, and today once again I'm joined by my brother Brian and partner at As Good as Gold, and today we interview John Adams, Chief Economist at As Good as Gold Australia. Good afternoon, John.
Good afternoon, sir. How are you going?
Very well, thanks, John. Look, thanks for your time again, really appreciate it. What I'd like to do, if I could, is take us all back to last Friday when something very rare and very dramatic, very significant took place in the US bond market. It experienced an inversion of the 1 to 10 year yield curve. Historically, this has been an extremely accurate indicator of an oncoming economic recession. I've heard Michael Pinto talk about this regularly. We've interviewed Michael, of course, one of the world's leading economists, and he constantly refers to the significance of the inversion. Can you explain to us what this inversion is telling us and why we should be concerned?
About 4 a.m., I was actually awake on Saturday morning Australian time, so it's still Friday US time. The inversion of the yield curve between the 1 to 10 did invert. It's been something I've been looking for the last 4 months, so it finally happened. The US Federal Reserve, so the US Central Bank itself, has written several papers and said that this is the most accurate predictor of a recession. So the last 7 recessions that have occurred in the United States, going back to 1969, saw that the yield curve did invert. Every time it's inverted, it hasn't failed. So what is it telling the market? It's basically saying that a couple of things. One is it's saying that monetary conditions are too tight. So basically that confidence is down. So in a normal bond market, if you're going to put your money away for 10 years, you should be expecting a higher rate of return compared to if you're only putting your money away for 1 year. But what happened was on Saturday morning, Australian time, basically it was more profitable to put your money away for 1 year compared to 10. So what does that signal? It signals a lack of confidence in short-term economic conditions. And that basically is an indicator that we're headed for a downturn of some description.
Okay, so I understand under normal circumstances, I want to see if I've got this right. I understand that one would expect a better return on a longer term investment, like typically a 10-year bond. So now that is reversed. And so we've got the market saying we do not, correct me if I'm wrong here, we're not confident about the immediate future. So we expect a better return, in fact, a bigger return than we would on a 10-year bond. So that's the case, isn't it?
Correct.
Okay, so how does that now impact on an economy? I understand that it is telling us something. It's a lack of confidence in the market, but how does that in turn then impact negatively on the market?
Okay, Daryl. So the inversion of the yield curve, what is it telling the market? It's basically saying that there's a short-term, a lack of short-term confidence in the economy. You're going to see banks finding it, pulling back on the availability of credit. It also shows that the economy is slowing and that monetary conditions are too tight in a slowing economy. So obviously we've seen a big bubble build up, in terms of debt. And basically, the US Federal Reserve raised interest rates from 0 to 2.5% over the last little while. And basically now what they're saying is that that interest rate is too much for the bond market and the share market to handle. So this is an indicator that the market feels that the economy is slowing. And every time that this happened since 1969, it has gone into recession.
Okay, so this bond market yield curve has become, it seems, a real barometer of the economic conditions. So it's taken very seriously. A 2018 research note from the Federal Reserve Bank of San Francisco's officials, Michael Bauer and Thomas Mertens, titled Economic Forecasts with the Yield Curve, stated, every recession over this period, January 1955 through to February 2018, was preceded by an inversion of the 1 year, 10 year yield curve. Now, this is pretty powerful. This is pretty compelling. So I'll repeat that. Every recession over this period, January 1955 through to February 2018, was preceded by an inversion of the 1 to 10 year yield curve, and we've just had one. We've just had an inversion. So could I ask you, John, to take us through, say, 1969 through to 2019, where I believe there have been 7 recessions. So if you could just take us through that and explain the process to us.
Thanks very much for the question. Yep. So we have had, just to go back slightly a little bit further. So since 1955, there has been 8 recessions, and the 1 to 10 year yield curve has inverted of every time. Now, there was one false positive recording, and that was in 1965. So the yield curve inverted for 3 days, and the economy slowed, but it didn't technically go into recession. But since 1969, every inversion has led to has sort of gone on to a recession, and this is why the U.S. Federal Reserve itself. So this is the official government line that the 1 to 10 year yield curve has, is the most accurate predictor of a recession. Now, you would have seen a whole host of other commentators on YouTube. And there are some of them that, a lot of Americans that in the last few months, they've said that the yield curve has already inverted. So other parts of the yield curve already inverted, like the 1 to 5 or the 2 to 5. So those inverted some months ago. But before I made any sort of big call about the significance of it, I was waiting for the 1 to 10 because the US government itself has said that it is the most accurate predictor of recession. So just to go through it now. So what I've done is, and we're just going to put this table up on the screen. So I took the data from the US Federal Reserve and calculated the spread or the difference between the 1 and the 10 year yields for the bonds. And then I said, well, what was the first date of inversion? So I have a column for that. So for the last 7 recessions, I've got a column there that has the date of the first day of the inversion. And then I have the first quarter of when negative growth happens, because a recession is when you have 2 quarters of negative economic growth. So I took the first date of the inversion and the first period of negative economic growth, and then I calculated what was the difference. So we have a spread between 3 to 27 months. And so obviously in 1969, we had the inversion in December of 67, and it took 21 months for the first quarter of negative growth to come through. The recession of 73, 74, it only had 3 months. In terms of the 1980 recession, took 19 months for the recession to come from the date of inversion. And then the 81 recession was 6 months. The recession of 1990 in the US, it was 20 months. So it inverted in early 1989, and then it took into 1990 for the recession to come. The dot-com crash in 2001. So the first date of inversion was in September of 1998, and it basically took 27 months for the recession to come in 2001. And then in terms of the GFC, so the first date of the inversion happened in December of 2005. And then obviously Lehman Brothers crashed in September of 2008. So basically, that's a very big spread in terms of, so if this pattern is going to continue, we've got either 3 months or we've got more than 2 years for the first quarter of negative growth to come. Now, why is this significant? So what I've been writing for the last few years is I've been saying that, Australia is headed for economic Armageddon. So what is that about? That is to say that we have the biggest bubble in the history of the country. At the same time, we've got the biggest bubble in the history of the world. So global debt is 244 trillion, more than 300% of global GDP. And we have the biggest credit bubble in Australian history, and it's all on property. And the bubble today, according to the Reserve Bank, which in their statement that they released in 2007, is bigger than the 1880s and the 1920s. And why is that significant? Because we had a depression in 1892 and we had a depression in 1929-31. So because of that, every economic crisis Australia has had since the arrival of the First Fleet has always emanated from overseas. And usually it has typically happened out of London, or continental Europe, or the United States. Now, The Asian financial crisis happened starting in Thailand, but we weren't. We didn't necessarily go into recession during that particular period. And while there was a bit of a slowdown in that period, it wasn't too disruptive, the Asian financial crisis. So my thesis for a while, based on what we have seen for the last 200 years, is because we've got a big debt bubble, because the world has a big debt bubble, there's going to be a shock. There's going to be someone in the global community who says, I can't pay my debts. And then once you see that default, it will start to spread throughout the financial system. And then Australia would be impacted, particularly if we were not prepared. And I would say we are the least prepared ever because we have massive amounts of debts, household debt, foreign debt, very low levels of saving, very low interest rates, a federal budget budget that's already in deficit. So we don't have any sort of federal government savings. So when the GFC happened, John Howard left $70 billion in the bank in terms of net government debts. So our metrics are very bad. And if a global shock were to occur, we are very ill prepared for that. And in my conversations with people in Parliament, they sort of said, well, where does this shock come from? How does it happen? And it's obviously when someone says they can't pay. And when you've got a lot of debt, this typically happens when you have a recession overseas. So America has been one of my big focuses because America is the biggest economy in the world. But obviously China has the biggest bubble out of any economy. But also you've got significant problems in Europe as well. So the metrics and the statistics coming out of China, it's not particularly believable. There is a lot of fraud and manipulation with what the government in China is saying. So an indication that the global economy is slowing. This US yield curve has been an important barometer for me to keep my eyes on. And obviously it's now inverted. So what I think we can conclude is between 3 to 27 months, assuming that the last 7 recessions are a guide to history, are a guide to the future, we should see some sort of economic shock.
So, John, 3 months to 27 months, I know how long that takes. Not very long at all. I've got children like everybody else, and we watch them grow pretty fast. And if you decided to start saving from this point onwards or start doing some corrections to your financial budget, I know it doesn't take very long. So I'm hoping it's 27 months, but I feel that it's going to be less than that. Anyway, there are some implications for the US and the global economy. I will start with the US first, and then we'll worry about the global economy. In America has been relying on 2 to 3% GDP growth for the past 5 to 6 years. What implications do you see now that a recession will probably have on negative growth, not only in the US, but the rest of the world? And where do you see exchange rates going from here?
Because we are headed towards recession. Now, the first point to make is that this recession coming is going to be different than in terms of the global financial crisis. And one of the reasons why is that they didn't take any aggressive action to soften the blow before the global financial crisis happened. I mean, they did cut rates in 2008, but it was a little bit too slow, too late. But I suspect that, Jerome Powell has said that they're going to stop quantitative tightening in September, that there's no more rate increases in interest rates. So maybe they'll wait a while, but we should start to see rates cutting back down later this year. So if the recession is 2 years away and they start cutting rates early, that potentially could try to soften the blow more so than if they just keep interest rates in terms of stable. So what are the implications for America and the world? Well, when you have a global economy that's got like massive amounts of global debt, and that debt continues to rise, obviously you need income to service that debt. Now, what does a recession indicate? It means that your national income for a national economy is actually going backwards. So you actually have less income to service that debt. And then basically what that means is, if you've got less income to service that debt, at some point someone's going to default. So usually a recession happens, a crisis happens either by rates going up and people can't pay because the debt servicing costs go up, or if you're going into recession and you haven't had a crisis yet, it could be a loss of income, as in an increase in unemployment or a company losing profits that could trigger people to default. So I think that's what we're going to see somewhere. And obviously this is a barometer for the US economy, but obviously given that the US is the largest economy in the world and the center of the international monetary system, we're going to see the global economy start to slow down significantly, and that will have implications for not just the United States in terms of meeting their debt obligations, but the Chinese, in terms of the Russians, in terms of Europe, etc. So what I expect to see is that if history repeats itself, we will start to see certain countries or certain countries, certain companies, certain individual households start to default on debt, and then obviously if that starts to spread, you then start to see a systemic crisis.
Yeah, well, that sort of leads into the next question on global implications. I mean, I've got here global debt now has risen to 250 trillion, an increase. It's around about 80 trillion from the beginning of the financial crisis, so 80 trillion increase. How will countries finance the interest? Because we all know we live in a debt-based society. So how will our countries, in your opinion, will pay this interest on the debt now that we face a probable recession?
Well, the short answer is that they're not able to. So that's why we're going to...
Yeah, not a laughing matter. No, I understand that. Darryl?
But look, I was going to make one point. Now, some of the viewers may have seen that last week I put out a piece through news.com with Martin North and an Irish financial advisor called Eddie Hobbs. Now, in 200 years of economic history, every crisis in Australia has started with someone blowing up overseas, and that's obviously spread to us. So obviously, if the US goes into recession, if other economies go into recession, if people can't pay their debts, that will start to affect the financial system, and that could spread to our banks, particularly because of how indebted Australians are, particularly through the foreign debt. But obviously, we've got a whole host of derivatives, 38 trillion worth of derivatives in our banks that have international counterparties as well. So we have some links to the global economy and to the global financial system that can affect us quite severely. But we did put out a thesis last week to say, because we're already seeing that property in Australia starting to fall. We're starting to see that Australians are pulling back on consumption of things like cars and furniture in terms of white goods. So we're starting to see a tick up in unemployment in New South Wales and Victoria. This is going to start in the construction sector. So our metrics in Australia are very close to what the Irish were before the global financial crisis. So even though we know now technically a global shock is going to come in the next 2 years, there is a possibility that we could still tip over into recession, or we could even sort of fall over and maybe trigger the crisis before the Americans formally go into recession. So in 2008. We were lucky because when the global financial crisis happened, we had a massive stimulus package around the world, but particularly in China. So we had the Chinese help us out. We had a domestic stimulus package. We had the Reserve Bank cutting rates. But this time around, the Chinese are tapped out on debt. So are the Americans. And so it looks like we don't have many lifelines to help us out to get out of this boat this time. So I just thought, for those viewers that have read my piece last week about Australia being the first domino to fall, we potentially could still be the first domino to fall in terms of the next 2 years. But we know that the global shock is coming, and this is exactly what happened in Ireland. So Ireland was collapsing in 2007. The housing market was falling. It started to affect the banks, and then when Lehman Brothers happened, it whacked the Irish banks on top. So the implications for the world, the implications for us are very bad. There's a whole host of Australians who are poorly placed at the moment with record levels of debt. and particularly for those that have signed up to some of these mega mortgages, it'd be extremely hard for some of these people to get out of their positions before this all blows up.
Yeah, sounds as if we better get our household budget in order just for preparation purposes. Okay, Darryl.
So, John, let's just confirm. We've got the largest economy in the world and the centre of world financial markets on track heading towards economic recession.
Correct.
Now, obviously Australia will be impacted. I guess the question's got to be to what degree, and a lot will depend on policy decisions made by government, central banks, and the timing of those decisions. So, as I read it, there are probably only two alternatives. I mean, we look at this toolbox that the government and central banks of the world apparently have, but at the end of the day, I see it as a restricted amount of tools in that toolbox. And so they've only got two options as I read it. One of them, and I'd like you to just share that with us now, is contractionary policies, so that we're talking about quantitative tightening, a real tightening of the economy. So that's one option. And let's just go through that first and see how that might play out first.
Sure. Well, the contractionary policies, I mean, that's what the US has been implementing probably since the late 2015, but they really ramped it up in 2017. So the rise in interest rates, the increase in quantitative tightening, that's what has led us to this point. Now, if they continue to tighten, or if they stop and just pause, that's going to basically, in effect, blow up. That will blow up in terms of the that will blow up the debt bubble. Now, it's interesting that some people, some of the financial market experts, think that now that we know we're going into the US is going into a recession, some people think that it will be a mild recession. And some people like Peter Schiff or Jim Rogers think that it will be a very significant recession/crisis because the amount of debt in the US economy is substantially larger than previous crises. So basically, if they do nothing, people will default and the debt bubble will burst, and we will have a contractionary, deflationary effect. And for those people who subscribe to Harry Dent or read Harry Dent's books, that's basically what he's forecasting, is that we're going to have global deflation because they can't rescue the global debt bubble.
There's an option too, John. It's something that I've read about in many financial papers. That is monetary stimulus and modern monetary theory. But I personally see a situation where the Australian government will start helicopter money and the development of the modern monetary theory. And I've looked at Finland. Finland has been trying UBI, which is Universal Basic Income, for 18 months now. And now it is presently throwing in the towel simply because they want to go back to where from their original standing on that. They don't want to see universal basic income at all. It's not working. So why does Australia think they can do better than Finland?
The short answer is that Australia can't do better than Finland. Now, so the inflationary type of policies is basically, if they don't want a depression, if they want to protect the debt bubble, they're going to implement the same sort of monetary cocaine and heroin that they tried 10 years ago. So zero interest rates, negative interest rates, quantitative easing, potential, things like universal basic income, a massive amount of new government spending, trying to prop this economy back up. Could be nationalisation of banks, could be bail-in, which is involuntary or mandatory confiscation of bank deposits to stop the banks from going bust. So these are all the tools available. They tried this 10 years ago, and all they did was blow up an even bigger bubble than where we were in 2007. You're correct, as you said before. Global debt is about approximately 250 trillion in US dollar terms, which is about 80 trillion more than we were in October 2007. Now, my reading of if I look at the IMF, if I look at the European Central Bank, if I look at the US Federal Reserve, if I look at our own Reserve Bank of Australia, but also our own politicians, one of the reasons why I sort of disagree with the debt thesis is because they will print. I mean, I think they will try anything and everything to stop a depression from coming, to stop a depression from coming, and they're going to print to oblivion to keep the debt bubble intact. And so if they do that, they're just going to create more and more debt to sort of keep the system stable, and that comes at a cost. And what is the cost? The cost is turning your currency, your fiat currency, into confetti. So whether it's us, the Australian dollar, or the US dollar, or the euro, etc. I mean that's what has been the history of money or currencies going back for thousands of years. That if you have a non-backed fiat currency and you print it to oblivion, the intrinsic value of that currency will revert back to what it is, which is zero, because no one will trust it, no one will want to use it, because people will say, well, that didn't hold its value. So I mean, before I joined As Good as Gold Australia, I mean that's why I started buying gold and silver, because I had a view, particularly if Australia got a shortened Labor government, that we would push the stimulus button very hard to try to keep this debt bubble intact, and that would have negative implications for the dollar, particularly because Australia has record levels of net foreign debt, and with all of this exotic economic policy that I think that the global elite as well as our elite are going to push, at some point our international creditors, so we owe in gross terms about $2.3 trillion of gross foreign debt. About $500 billion is $500 billion of that debt is a 90-day debt. At some point, someone will lose confidence in our ability to service our foreign debts, and you will see the dollar crash. So this is what happened with Turkey last year when the Turkish lira fell 32% in 3 weeks, and it's the same thing what happened with the South Korean currency in 1997 when the South Korean currency fell 40% in 3 weeks. So that's the flip side of, if you try to inflate your way out of a problem, like particularly of a problem of this sort of size and magnitude, it will have huge implications around inflation, around the purchasing power of the government's money, and obviously that will have a substantial impact on living standards and people's ability to meet the ordinary basic needs in terms of their everyday needs, from food to petrol to transport, childcare, etc. So obviously, that's my motivation for buying gold and silver. It is because to protect my family against what the central banks, I suspect, are going to do around all of this money printing, and that's the motivation for calling you guys last year and asking to be a part of the team. It's because we've reached this point where the global debt bubble is in trouble, and they can't allow the bubble to collapse. They can't let the banks fail. So they're going to print to oblivion to save the system, but it comes at a cost, and the cost is a failing currency.
Yeah, John, from what you've just said, it seems as though the Federal Reserve have got a credibility problem. I've got one last question, and Darryl will close after that. But and the question is based around the need for precious metals. But before I ask the question, I'm going to give you a quote. I'm going to give the audience a quote here from Neil Armstrong, who we all know is the astronaut who landed on the moon. And I'll give you the reason why I'm quoting this. There were only two problems to solve on going to the moon. They were how to get there and how to return. The most important thing is you'd better solve both before you leave. It seems to me that the Federal Reserve knew how to print the money, but they don't know what comes after. And I lead to the fact that it seems that the Fed has been blinded and there is no turning back the clock. People like Ray Dalio, Jeff Christian, and others in the finance world are recommending a good ratio of precious metals in all portfolios to prepare for the next financial disaster. John, your thoughts?
Yes, I mean, the thing is, like a lot of the last year we had the largest amount of net purchases by central banks for gold since 1967. We have a whole host of high net worth individuals. They're all saying get gold in your portfolio. Why? Because of the state of the monetary system, because of the state of the level of systemic risk in the financial system, and they're all basically saying that you need some form of protection just in case if everything goes haywire. And historically it's been the US dollar, and it was the US dollar 10 years ago, and historically it's been US treasuries. But given the state of the US economy, given the state of 22 trillion of federal government debt in terms of the United States, and all this quantitative easing, and the US Federal Reserve shrank their balance sheet a little bit, but nowhere near to the claims that they said they could. So they had a reasonable amount of, they had some debt on the US federal government balance sheet in the GFC. They blew it up to 4.5 trillion. They've brought it back to about 3.8, 3.9 trillion. And they always promised that they could always go back to where they were before. Well, now they've proven that they can't, because if they did, it won't just lead to a recession; it would lead to a depression, because all of this debt would have to blow up, and that would ricochet throughout right throughout the U.S. economy, but in terms of the global economy. So basically, that they know that they've reached the limits of quantitative tightening, they've reached the limits of raising interest rates, and now they have got to go back into the opposite direction to protect the debt bubble, and that's going to create massive amounts of inflation, massive amounts of risk, and that's why all the smartest cookies around the world are saying get some traditional forms of monetary insurance, gold and silver. So that's what I'm doing. That's what a whole bunch of smart people are doing. I mean, Jim Rickards, when he came last year to the As Good as Gold conference, and Michael Pento and Peter Schiff and all of these smart cookies around the world. We're reaching the apex of what we've all been talking about for several years, and everyone needs to get some sort of insurance, because every government around the world have said they're going to print. And obviously in our last video, we talked about negative interest rates. We talked about the IMF saying that they want interest rates to go to -3%, -4%. Well, why is the IMF saying that? It's because the elites are not willing to accept the bursting of the bubble, and they just want to kick the can down the road, and push interest rates to very severe negative levels. But it comes at a cost. And for the little citizen, or the average citizen who's unprepared, look at Argentina, look at Venezuela. I mean, they're the sort of examples of when a monetary system goes haywire at a domestic level, and everyone needs to guard against that type of event, because when Labor comes into power federally, that's their inclination. It's to print, it's to spend. I have a lot of contacts in Canberra, politicians and advisors, and I continually say to them, there's not one advocate in the federal parliament that is talking about the stability of the dollar and about sort of managing the currency. So I've got significant fears about the future value of the dollar, the future value of the stability of the Australian dollar and the currency. And so because everyone's pushing the stimulus button, for the sake of my family, I'm taking, appropriate steps and taking insurance because of what I suspect they're going to do. And the best form of insurance is physical gold and silver bullion. And here we are.
Yeah, I'm so glad the Federal Reserve does not run NASA. I think we'd be on all sorts of strife. Darren?
Look, John, I've repeated this quote many times, but I go back to 1997, and I was speaking with my since then lifetime mentor, and he said, Daryl, I do not care what happens in the world tonight. It's quite relevant now. I do not care what happens in the world tonight, because tomorrow I'll still be able to get up and party. Now, something did happen on Friday night, but Peter would have still been able to get up Saturday morning and party. Why? Because he has been a great supporter and purchaser of precious metals over many years. So he has a store of wealth. He's preserved his wealth. So it really doesn't matter what happens. He knows he and his family are covered. They're insured. So thank you again, John. We just really appreciate your comments, and we know you've got a big night tonight. You've got a major debate coming up, and we wish you all the best of luck with. You won't need any luck, John. You'll handle that in your stride. But we wish you well this evening. A reminder to all of our viewers, of course, that we do have a GFC 2.0 conference coming up. This is coming up very quickly now. It's almost upon us. It's only a month away. Melbourne, Saturday, April 27. Sydney, Saturday, May 4. Details are listed on the link below. This will give you, of course, an opportunity to catch up with John and members of the As Good as Gold Australia team at a more personal level. These events are always received really well, and this will be no exception. So we would really look forward. We have some tickets left. We would look forward to seeing you there. And finally, and most importantly, thank you to all of our subscribers for their absolutely ongoing and valued support. Until next time, stay well, stay focused, and bye for now.
Thank you.